Okay, everybody, welcome. My name is Jason Parker. I just hit the record button, so we will have this available for people that couldn't make it today. We've got people here from all over the country. One last reminder, type your questions as we go, and I will be sure to answer the questions at the end of the presentation. This is so much fun for me because today this is a presentation that was sent out to everybody that's part of the Retirement Budget Calculator community. And it's Parker Financial is my investment advisory firm. So today we get to talk about Retirement Budget Calculator, but the topic of today's presentation is investing in retirement. And I know that people are a little bit concerned right now with everything going on in the world, and so I want to address some of those concerns. But I also want to talk about what it means to have a really good strategy from my perspective as somebody that walks life with people and helps them do this. You know, I'm going to turn off this video for just a short minute or for until the end of the presentation here, just because that way I can see my screen. Okay, there we go. The retirement calculator, retirement budget calculator, is very powerful for helping you to create a plan. But then you need to implement the plan, you need to create an investment strategy, you need to monitor that investment strategy, and you need to make adjustments to it over time. And so that's what we're going to talk about. I was reading a speech that Alan Greenspan gave a long time ago, and he started it with this. It was supposed to be a joke, I think. I don't think he's the first one that ever said this, but one of the funny things about the stock market is that every time one person sells, another person buys, and they both think they're right. Interestingly, though, in between all the buying and the selling is a stock's current price, which reflects the aggregate expectations about risk and return. So let's talk about stock picking here for a minute. As we get into today's presentation, I want to talk about financial science. So what I'm sharing with you are not just a practitioner's real life experience walking life with people, but I want to share with you what the academic theory or the academic community has to say about this. And so how we decide who's in the academic community, and in many instances, we will talk about these guys that won the Nobel Prize in economics. So Harry Merkowitz for modern portfolio theory, William Sharpe for capital asset pricing model, and Eugene Fama for the efficient market hypothesis. Let me just tell you a little bit more about these guys. So modern portfolio theory proposes how rational investors use diversification to optimize their portfolios. Now, rational is kind of a funny word in today's world, but rational investors, and how a risk asset should be priced. Modern portfolio theory assumes that investors are risk averse, meaning that given two assets that offer the same expected return, investors would prefer the less risky one. Thus, an investor takes on increased risk only if they're going to be compensated by a higher return. Capital asset pricing model, William Sharpe, and the reason I'm telling you about these, you guys, is because I'm going to come back to this in a minute, but William Sharpe, he says capital asset pricing model has to do with the price of a security, its risks, and its expected return. And he says there's two key takeaways from capital asset pricing model. Number one, the most efficient strategy is to be broadly diversified. And he says that there will be a reward and higher expected returns for bearing risks of doing badly in bad times. And then Eugene Fama, the efficient market hypothesis, asserts how financial markets are informationally efficient and one cannot consistently predict returns in excess of average market returns. It's important that you consider the sources that you're using for your investment advice and your retirement planning. Are you taking investment advice from Main Street, Wall Street, or academia? I consider Main Street to be people like your friends, your coworkers, your family members, people who mean well, but they may not have they may not have spent enough time to really understand your situation to give appropriate advice. Wall Street is what I consider to be like brokerages, banks, and insurance companies. And sometimes it can be difficult to decipher the truth because oftentimes there's a sales motive, and so it can just be hard to decipher the difference between research and a sales pitch. Academia, on the other hand, has a different motive. Their motives are to research and to teach, and they're going to be different than Main Street or Wall Street. If you and I are sitting around together trying to figure out which of these different sources is the most reliable, I would encourage you to start with the academic research. But I will tell you, as a practitioner who actually walks the life with real people, I have the unique opportunity to spend the majority of my time not just thinking about how all of this works in theory, but we actually help people implement it into an actionable strategy with the goal of helping people achieve clarity, confidence, and freedom, which is the tagline of the podcast and the book and everything we do: clarity, confidence, and freedom. Okay. So we have to talk about where we're at in the market today. And there's lots of reasons right now to be fearful. Stocks, of course, we're officially in a bear market, down more than 20% from their highs. Inflation's running over 9%. Interest rates are rising, which means bonds are getting clobbered, especially if you're a bond mutual fund or bond ETF holder. We're coming out of a global pandemic. The supply chain was disrupted. We've got Russia attacking Ukraine, which of course has impacted energy and oil and food supply. We've got China talking crazy towards the United States and Taiwan, and we've got trade tariffs, trade war going on with China from both sides. And then I like this quote from Warren Buffett. He says, "Be fearful when others are greedy, and be greedy when others are fearful." One of the things I wanted to point out to you, and you guys know this, it always feels different when you're going through a bear market. But the great thing about this chart is it shows us all of the different, not all of the different, but many of the different things that have happened since 1970 till today. The oil prices quadrupled, S&P 500 down 43%, gold hits a record high, the savings and loan crisis, the Russian financial crisis, Hurricane Katrina, Iraq war, September 11th, subprime mortgages, the financial crisis, home prices bottom out. I mean, look, we have been through a lot, and the market is very resilient. Warren Buffett says, don't bet against the United States of America. And I like this quote from Abraham Lincoln. It's one of my favorites right now when it comes to this word discipline. Markets have rewarded discipline. Abraham Lincoln says, discipline is knowing the difference between what you want now versus what you want most. Discipline is understanding the difference between what you want now versus what you want most. I would say a lot of the people I'm talking to right now want safety. That's what they want right now. But what they want most is to be confident that they're going to have a good long-term investment strategy. If you chase after safety in a time of volatility, you could be jeopardizing your long-term well-being. I would encourage you, if you're not in a position where you're exercising discipline, it's a key component to a good strategy. Stock market returns have always been volatile. This is looking at the CRSP 1-10 index returns by year, and this is from 1926 through 2021. You can see positive years in the market have been 75% of the time. Negative years have been 25% of the time. Negative years are normal. It's normal to have bear markets. I also think it's easy to forget that we just came through 3 double-digit return years for the S&P 500, and so, to think that the market's only going to go straight up forever is not realistic. The hard part, I think, about this is that we've had a tremendous number of people retire recently. And I have no doubt that when we look back in history, 2022 is going to be considered a rough year to start your retirement with inflation, stock market volatility, there's no safe place to hide. Your crypto didn't help you, your gold didn't help you. Your bonds didn't help you, your stocks didn't help you, money sitting in bank accounts lost 9% to inflation. So it's a challenging environment, and I don't want to make light of that, but that's one of the great things about using a tool like the calculator and about having a disciplined investment strategy. One of the things I want you to remember is that, and this chart really helps us understand the importance of staying invested in order to capture the equity premium. And what it shows you is that missing out on only a few days of strong returns can drastically impact your overall performance. So you can see from 1990 through 2021, the S&P 500, you earned a 10.76% if you just bought and held and stuck with it the entire time. If you missed the one best day, you had 23,000 instead of 26,000. If you missed the 5 best days, you only had 16,000. If you missed the 15 single best days, you only had 9,000. And if you missed the 25 best single days, you only had 5.55%. Sitting on the sidelines, trying to get in and out of the markets, kind of like trying to switch lanes in a traffic jam. You know, you get into a traffic jam and you see these guys are weaving and bobbing from one lane to the next, and it's really just a waste of time. If anything, it's potentially putting them in danger of an accident and even maybe causing traffic to move slower. So be careful about this idea of trying to chase safety or chase returns. You know, the same thing happens when there's over exuberance and people are moving all their money out of safe money into at-risk positions. So I'm setting a framework here for you that's important. I want to talk to you about stock picking. So there was a research paper that was done by JP Morgan Asset Management. It was back in 2014. It was called The Agony and Ecstasy: The Risks and Rewards of a Concentrated Stock Position. And what it did was it looked at individual stock picking, having concentrated stock positions compared to the performance of the overall Russell 3000 index from the year 1980 through 2014. For those of you that don't know, the Russell 3000 index measures the performance of the largest 3,000 US companies, representing approximately 98% of investable US equity market. It's reconstituted annually to ensure that the new and growing companies are reflected. And the researchers analyzed all the stocks that were part of the Russell 3000 from 1980 to 2014, which included a database of 13,000 large, mid, and small cap stocks. And there were a few important takeaways that are summarized in the executive summary of this report. What they said was that some companies within this Russell 3000 index, some companies substantially outperformed the broad market and maintain their value. However, the odds have been stacked against the average concentrated stockholder, according to this paper. So here's the first thing it says: the risk of permanent impairment using the universe of Russell 3000 companies since 1980 shows that roughly 40% of all stocks had suffered a permanent 70% decline from their peak value. 40% of all the stocks that were part of the Russell 3000 during that time period. The next bullet point states that 40% of stocks experienced negative lifetime returns versus the broad market. The return of the median stocks since its inception versus an investment just in the index, in the Russell 3000 index, was negative 54%. 2/3 of stocks underperformed the Russell 3000 index, and for 40% of all stocks, their absolute returns were negative. This paper says that since 1980, over 320 companies from 82 through 2014 had been deleted from the S&P 500 for business distress reasons. The hard part about that is we think it's almost un-American for a company to go out of business. But I looked it up on a website called Statista, and it says that the average lifespan of a company on the S&P 500 index currently is about 21 years, and that number's declining over time. So even the big, strong companies, the companies big enough to make it into an index like the Russell 3000 or the S&P 500 index, they don't last forever. And so there's just so much risk with taking concentrated positions in stocks. I mean, look, we have so many examples of recent history. WorldCom, right here locally, for those of you who remember Washington Mutual Bank, Bear Stearns, Lehman Brothers. You could look back at what happened with Boeing, for those of you that are Northwest people. I mean, just these companies that in your mind you think they're going to be around forever. The world changes, life changes. Having concentrated stock positions can hurt you. I remember earlier last year, DocuSign was trading at $250 a share. I think now it's down to like $60 a share. So be careful with taking concentrated stock positions. I like what Jack Bogle says. Jack Bogle's the founder of Vanguard. He says, don't look for the needle in the haystack, just buy the haystack. And the JP Morgan study revealed that 40% of companies suffered a permanent decline of 70%. 2/3 of companies do not perform as well as the index, and only 7% of the companies outperform the index averages. Let me say that again. Only 7% of the companies in the Russell 3000 index, 98% of the stock market from 1980 through 2014, only 7% of those companies outperformed the index averages. Those are really crummy odds of outperforming when you could have just bought the entire index and enjoyed the returns of the market. So you can see stock picking is like trying to find the needle in the haystack. And the study shows you that stock picking comes with a high degree of risk and that there's few reasons to believe it's going to work. Diversification can help you achieve the returns that you need without taking on sufficient or significant concentrated risks. So instead of attempting to discover the next big winning stock, just buy a low-cost index fund and be broadly diversified. Warren Buffett, he's a stock picker. He's one of the few people that have consistently outperformed over a long period of time. And that may be fun to do when you're in the accumulation phase of life. But boy, let me tell you, if you're heading into retirement, playing that game could be catastrophic to your retirement security. I really strongly recommend that you consider using diversification. What we're trying to accomplish with diversification is we want to eliminate the extreme outcomes. We want to eliminate the extreme outcomes. When you're diversified, you're never going to get those huge wins, but we're trying to avoid those companies that go to zero. When you understand how difficult it is and how few individual stocks outperform the index, you can just diversify away that risk and avoid permanent destruction of your financial future by trying to be an individual stock picker. Now, most of you know this, but because I see so many people in real life, I get to see the portfolios you have, and you may know it intellectually, but you're still buying individual stocks because you think you are going to be able to identify those 7% of stocks that outperform in the long run. Again, if you've got a lot of time on your side, go ahead and play that game. But if you're getting ready to retire, it's too much risk. Asset allocation simply means not putting all of your eggs in one basket. And this whole idea behind asset allocation started with a study that was done back in 1986 called the BHB study. It was updated in 1991. And essentially what they concluded was that asset allocation explained 93.6% of the variation in a portfolio's quarterly returns, and that stock picking and market timing played minor roles. Some of the more recent discussion around this early work was that its focus was on the variability of returns, not on return levels or relative performance, which is what most investors are interested in. I love this Skittle chart because what it shows us, it's an example of how trying to pick the right stock or even the right asset class at any one time is going to be very challenging. This is looking back over the last 15 years, and it's looking at both US and non-US markets. There's very little predictability that can be derived by looking at this. There's nothing that shows you in this chart that you're going to be able to consistently predict the best asset class from year after year. Take a look here. You can see 2007, 39.8% emerging markets were the best at performing asset class that year. 2008, of course, were 5-year US government bonds. And look what happened to emerging markets. They were negative 53% in 2008. And then 2009, emerging markets were the best performing asset class again. 2010, it was real estate. 2011, you've got this, the point of the exercise is to help you understand, and this is, I think it was in Michael Kitsis's website that I saw this, but when you create a broadly diversified portfolio, you're going to have some of all of this. And so I'll have clients call me up and they'll say, Jason, we've got this really crummy position here that's doing bad this year. Why don't we get rid of that and move the money into the stuff that's doing good? And that's the exact opposite of what we want to do when we're diversified. Diversification means that as an advisor, you always have to apologize because hopefully there's going to be something that's performing well in a portfolio and something that's performing poorly. 2022, we see a lot more asset classes performing poorly than performing well, of course. The key is you want to be broadly diversified across asset classes, across sectors, and across the entire globe, and you do that intelligently. Many of you may remember the lost decade, And I wanted to focus on this because it's still fresh in people's memories. This is that looking at that period from 2000 through 2009. And there's a lot of talk about the S&P 500 during that period of time. The S&P 500 was negative 9%. This is a chart that was put together by Dimensional Funds and some of the research that they do. But you can see the US small cap value index was up 218%. Large cap was up 48%. Real estate was up 176%. The international market was up 29%. And so sometimes what I see when I meet with people is they say, well, I'm just going to simplify everything. I'm going to put all my money in the S&P 500 index. Most people don't buy that, beat that anyways. It's got a low fee. It's going to be simple. And then you end up in a situation where you potentially could significantly underperform when you think you're doing the right thing by being diversified across 500 of the largest companies. And I'm going to show you specifically what that risk looks like here right now. So now, as I start to talk about backtesting portfolio asset allocation, again, looking at a bad time, so from 2000 through 2010, remember, this is not a recommendation for any kind of asset allocation for your specific situation, and past performance is no guarantee of future results. I believe that history can help us understand what has happened in the past, which can be a guide for us in the future. So this first thing that we're going to look at assumes that we started with $1 million and we're invested in the S&P 500. We did no rebalancing and we took no withdrawals. So you can see we started with $1 million from 2000 through 2010. Now that last chart was only from 2000 through 2009. This is going through 2010. The final balance on that $1 million was $1,036,000. You started with $1 million, you ended with $1,036,000. Now, the next thing that we're going to look at, the second portfolio I want you to look at, is what if we had been diversified across 9 different asset classes, equally diversified? So we put no thought into how to diversify. We just said, look, we're going to have 9 different asset classes. We're going to put 11.11% in each one of them. And those asset classes were REITs, the total US bond market, cash, small cap, global bonds, high yield corporate bonds, US large cap, international developed markets, and emerging markets. Again, we're still assuming no portfolio withdrawals and no rebalancing, but look at the difference. You started with $1 million. At the end of from 2000 through 2010, you had over 2 million because you took and you used asset allocation to be broadly diversified. Do you see why what William Sharp and Eugene Fama and Harry Merkowitz were explaining about the benefits of diversification? A compounded annual growth rate of 0.32 versus 0.654%, a drawdown of 50% down compared to 41%, doubling your money versus having what you started with just by being broadly diversified. The next thing I want you to look at is what happens with portfolio withdrawals. So in this next analysis, this next back test I want to share with you, we start with the S&P 500, assuming you take 100% S&P 500, we do no rebalancing, but now we're going to take 4% withdrawal per year. We're going to say you're retired. So you start by taking 40,000 a year and you adjust that 40,000 by inflation every year. So in this scenario, you started with $1 million. By 2010, your $1 million is now only worth $425,000. Whereas if you had used the same asset allocation as before, being broadly diversified across those 9 asset classes, you had $1,261,000. That's a huge difference in the outcomes by using diversification to your benefit. Okay, the next thing I wanted to show you, and the final thing I wanted to show you on back testing, is what if you included rebalancing and using those 9 different asset classes? Now, I will tell you the purpose of rebalancing generally is not to have more money. It is to help reduce volatility. That would be the purpose of it. Volatility is just noise until you retire, but once you retire, volatility becomes real risk. So if we look at that, if we look at this same portfolio here, and we say, okay, now we're just going to do a rebalance every year. We're still taking those withdrawals. Oops. You can see you took 4% out per year, you adjusted it for inflation, and now you've got 1.3 million as your ending value. You'll notice though, again, reduced volatility. So your worst 1 year without rebalancing was -28 versus 25. The max drawdown was 46 versus -42. So again, I think of rebalancing as a risk mitigation tool. In this case, you end up with more money after taking those portfolio withdrawals. Okay, another quote from Jack Bogle. He says, investing is not nearly as difficult as it looks. Successful investing involves doing a few things right and avoiding serious mistakes. I will tell you, as an advisor, I feel like I spend a lot of my time helping people avoid serious mistakes. And this comes in all shapes and sizes. People coming in because somebody's trying to sell them this, that, or the other thing, or they're promising them some kind of really high return, or they're promising to eliminate risk completely from their portfolio, or they're trying to get by crypto or something that really has the potential to have a devastating impact. So sometimes just avoiding mistakes is an important part of all of this. Okay, as we continue along, we've talked about asset allocation, we've talked about diversification, we've talked about rebalancing. The next thing I want to talk to you about are factors. So we talked about Eugene Fama early on. He won the Nobel Prize in economics. He's a professor at Chicago Booth School of Business, and he's also on the board for dimensional funds. Well, he's worked closely with Kenneth French, and Kenneth French is also known for factor models, and he's also on the board at dimensional funds. And factor research is a way to organize historical data to try to understand what drives the differences in returns across different groups of securities. From the research that is done on these factors in these models, you can glean insights about the drivers of expected returns and the differences in risk across different asset categories. The three original factors were market risk, value over growth, and small cap over large cap size. Today, momentum, profitability, and investment have also been identified as factors. Asset allocation models based on factor-based framework have become incredibly popular in the investment community. Looking at averaged annualized returns going back for decades, you can see what this chart shows us is that small caps beat large caps on a rolling 10-year period. The longer the time period, the better this looks. So you can see over rolling 10-year periods, 70% of the time, small cap beat large caps. It's not going to happen every year, but over a long period of time, this is what the history has shown us. Value beats growth 80% of the time on a 10-year rolling time period. High profitability beat low profitability stocks over 92% of the time over a 10-year period. So what we can do is within a portfolio, instead of trying to guess the best stock, what we can do within a low-cost ETF is create these factor tilts, if you will. So we still start with the broad market, but then we say, okay, let's tilt the portfolio a little bit to small cap. Let's tilt it a little bit to value. Let's tilt it a little bit to high profitability versus low profitability. Okay, the next piece to this is going back to William Sharpe. Again, William Sharpe was professor emeritus at Stanford. He won the Nobel Prize back in 1990 for capital asset pricing model. And in 2019, when he was 85 years old, he was interviewed by Barron's. In the article is titled "How to Secure Lasting Retirement Income," I want to share with you a few quotes from him in this article. He says, "The most difficult problem in finance is knowing how to strike a balance between having enough income to meet your current needs and having enough to get you through your lifetime. The most difficult problem in finance." He says, "Over the course of my career, I have always been interested in individual investors, and my earlier work focused on helping people accumulate money. His later work now is looking at helping people deaccumulate, helping people transition into retirement." He says, "If you invest your money in almost anything except for an annuity with a cost of living adjustment, you're going to be subject to two kinds of uncertainty: investment uncertainty and mortality uncertainty." Another quote, he says, "When you retire and you make your initial decision on buying annuities, investing, and adopting some sort of spending plan, I would think it would make sense to sit down at least once at the outset with a financial advisor." And then he says, "We've been doing he says, we who have been on the investment side have been babbling about pooling investment risk all our lives. Diversify, diversify, diversify. And yet when we retire, longevity risk is at least as big a risk as investment risk. And you really should consider pooling some of that pooling some of that, particularly as you get into the later stages of retirement. The way that you pool mortality risk is by pooling life expectancy using a contract from an insurance company called an annuity. In this interview, the guy that's doing the interview says, your ebook outlines a strategy that you call a lockbox. Can you take us through it? And William Sharp says, the idea is that you segment your money. He says it's similar to using buckets, but with a time component. He says the bottom line is that bucketing your assets in annual increments with different initial asset mixes in these lockboxes can provide a more efficient production of retirement income over time. I just got to tell you that again. The bottom line is that bucketing your assets in annual increments with different initial asset mixes in these lockboxes can provide a more efficient production of retirement income over time. So he's talking about using a different asset allocation for each year of retirement. That gets pretty clunky when you're trying to figure out how much money do I need for each year. So in the retirement budget calculator, what we do is we create 3-year segments. Now, some of you are saying, Jason, why 3 years? Well, historically, if you've had enough cash on hand and we go into a bear market, historically, if you've had at least 2.5 years of cash, if you had 3 years of cash, you're going to cover most of the risk of being able to recover from that bear market. Not all of the risk. You probably need about 4 or 5 years to cover all of it, but 3 years covers most of the risk. And then the second bucket is year 4 through 6. Now, one of the things that we have to challenge, because going back to this idea of the rational investor, this bucket would be cash, right? You're going to accept inflation risk to have some of your money that you're pulling from, because you've probably heard me say before, taking money out of accounts that are falling in value is like being stabbed and going to donate blood at the same time. So having some money in cash means, yes, we're fighting inflation, but no, we're not losing anything as the market's going down. It gives you the ability to rest and to know that you have time to let these other assets recover. The second bucket is the one that sometimes can throw people for a loop. Now, you can create an asset allocation for the strategy for this bucket. But one of the things I want to clarify for you is that there's some people today that think about buckets different than I think about buckets. For example, some people would say you would have a 3-bucket strategy with cash, bonds, and stocks. There's been research that shows that rebalancing a portfolio actually helps you, because what it does is it forces you to buy low and sell high. So when you only have those 3 buckets, you lose out on the benefit of rebalancing because you're just liquidating the portfolios. In this scenario, what I'm going to show you in just a minute is closer to what William Sharp talks about, where he says you create a different asset allocation for each segment. Now, in the second bucket, if we know that our goal for our money is to get, let's say, 3% or 4% per year, and we have the ability to go and we can get 3% or 4% per year by buying something like a CD from a bank or a fixed, a multi-year guarantee annuity contract from an insurance company. If we can get that fixed rate of return with no risk, that's the return that we need, or we can keep all the money invested. So often I see people that say, I want to keep the money invested for the hope of getting a little bit more when this money is needed in 4 to 6 years. So the question becomes, is that really a rational decision? Because if you end up having this money safe and this money in a low risk position, now we've got 6 years, which would historically cover just about every bear market we've seen in our country. No guarantee that that's going to be the case going forward, but this is just a different way to think about structuring these buckets. So here's a better illustration for you. The first bucket would be cash. So just low risk, money market, we say high yield savings account, someplace where we can pull money from on a monthly basis to create that paycheck for you. The second bucket could be something like 60% bonds, 40% stocks. If you're comfortable taking a little bit more risk rather than using a bank certificate of deposit, we could create an asset allocation that's more conservative, still rebalancing the portfolio every year so that we're benefiting from rebalancing on that segment. The third segment says we can have 60% stocks, 40% bonds. These are very simple asset classes, you guys. So of course, we would recommend being much more broadly diversified than just the simple, large cap stocks and bonds. But just to give you an idea here. So your third bucket would say this is money you don't have to touch until year 7, so we can take a little bit more risk, have more equity risk in there. The last bucket says, okay, this is money that we're not going to have to touch for 10 years. Now we can be 80% stock, 20% bond. Again, using asset allocation for each bucket, diversifying across each bucket, rebalancing each bucket so that we benefit from diversification and rebalancing. The interesting thing about this is if you started with $1.6 million, like we talked about in our hypothetical scenario, and you look at how this asset allocation actually is built across all of these different segments, you would notice you've got this 210,000 in cash, and then you've got 418,000 in bonds. So between these two, we're at about 37% in fixed income, and then 62% of your portfolio is in stock. So what you end up with is that 60-40 stock bond portfolio that everybody talks about in a traditional 60-40 stock bond split. But now you've just done it in a way where you've diversified based on time segments, based on when you're going to need the money, and you still benefit from things like rebalancing, which has been the argument against using buckets in the way that a lot of people do this with cash, bonds, and stocks. This is saying use diversification for each one of the different segments. The next thing I want to talk to you about is the do-it-yourself community. You guys know I love the do-it-yourself community. We're building tools to make your life better, and I think those tools are going to keep getting better over time. But if I didn't tell you about the research that's been done about the value of working with an advisor, I feel like I'd be not telling you the whole story. And so it's important for you in the do-it-yourself camp to understand the research that's been done. And some of you, and it drives me crazy when I see this, people focus on the cost of hiring an advisor. They say, I don't want to pay 1% per year to work with an investment advisor. So let's just look at a couple of the studies that have been done so that as you're making this decision about cost, you're weighing it against the value. This first one is a study that was done in Canada. It says after adjusting for almost 50 socioeconomic and attitudinal variations, the survey found that those working with an advisor accumulated 290% more, or 3.9 times more assets after 15 years compared to non-advised investors. So this is Canada. This is the Centers for Inter-University Research and Analysis, CIRNO, and it was called the Gamma Factor and the Value of Financial Advice. This is a report that was done over a long period of time to say people that have advisors, that don't have advisors, what's the difference? 3.9 times more assets after 15 years. The next one, of course, is Vanguard. Vanguard says that working with an advisor can, for many people, end up with 3% in net returns. Now, some of you heard the interview that I did with the gentleman from Vanguard, and that's 3% in net returns. Assume you're paying 1% in fees. So in dollars and cents, you pay, let's say on $1 million, you pay 1%, which is $10,000. In exchange, you average 3% or $30,000 on that 1 million. Is that something that you think is a value that you'd be willing to pay for? Morningstar did a similar research. What they came up with was, they said 22.6% more certainty equivalent income when compared to a simplistic static withdrawal strategy, or 1.59%. So you look at all of the different studies that are being done out there, and you see that people that use advisors end up with more money. I think you just need to be aware of that. And there's a couple of other things to consider too. You have to accept that cognitive decline is a real thing, and that the older you get, your ability to do this effectively, you may lose your ability, number one. And number two, we found that oftentimes one spouse is better at this and with the finances than the other spouse. If you don't get this taken care of before you kick the bucket and you leave your non-financial spouse with having to figure this out, you are subjecting them to you guys not being able to make this decision better, and then potentially meeting with somebody that's just trying to sell them something rather than really work in their best interest. So really consider the cost of working with an advisor versus the value that you receive. One of the cool new things that we did in the retirement budget calculator is we now have this ability. You can click on My Account, and then you click on Advisor Accessibility. You check this box and you hit Submit. Those are the 4 steps. When you do that, it's going to send you an email that says you've given us, Parker Financial, the ability to see your information. And it's going to send us an email saying that you have decided that you'd like to work with an advisor. The retirement budget calculator is a very powerful tool, but here's the problem. Once you create the plan, you need to implement the plan, you need to create an investment strategy, you need to monitor the plan and make sure everything's working as it should. Implementing the plan and developing an investment strategy is not easy. And as you get closer to retirement, you're entering a time of life when you can't afford to make a mistake. Unfortunately, I've seen too many people take the information from the calculator, bring it to somebody that's just trying to sell them a financial product, an insurance product, an investment portfolio. And I've seen people try to do this on their own. And then they find, by the time they reach out to me, I look at what they're doing and they just don't know what they're doing. You guys have to remember that advisors, we're spending all of our time. This is what we do all day, every day. I was talking to my stepdad the other day and he said, Jason, I don't know anything about this. He said, you come down here and you stand next to me as I'm putting a building together. He builds commercial real estate. He said, I'll bet you don't know a thing about it. And he's absolutely right. I don't know how to build a building. So today we're bringing you the calculator. We have the ability to incorporate investment management, but we're bringing you financial science to help you implement a plan, investment strategy, monitor it, oversee it, look at your taxes every year, and help make sure that what you're doing is optimized. So if this is something that you're interested in, you log into the retirement budget calculator, click on My Account, click on Advisor Accessibility, check the box and hit Submit, and then somebody from my team will be reaching out to you to help you get started. We've got a disclaimer. Just remember that none of this material is presented to serve as the basis for a financial decision. I've made the best efforts in preparing the presentation, but make no warranties or representations. Some of the data is performance-based, which is hypothetical in nature. Some of it's hypothetical in nature. So, past performance does not guarantee future results. The advice, so because this is being recorded, my advice may change over time based on new data and new research and all the academic financial science that's taking place in the world today, which we're going to talk a little bit more about. And then, of course, at the end of the day, unless we're working together, where I'm your advisor and we're walking life together, you have to be responsible for anything you do. So please don't take anything, go make a mistake in your financial life, and then come back and blame me for it. You have to be responsible for this. Parker Financial, of course, we're Sound Retirement Radio, Sound Retirement Planning. We have an insurance company, Parker Financial. We're located in Silverdale, Washington. And Retirement Budget Calculator LLC and Parker Financial LLC are affiliated entities under common control.